Hello, David. How are you?
Good, Mark.
What's your role at Montgomery Fund, and how do you find working with Roger? Now, be honest, he's not watching, okay? He's not here. Now, be honest, no one's watching.
Well, I'm the CEO of the business, Mark, and I joined Roger in June nearly 3 years ago.
Yep.
And I guess my role is to worry about the nuts and bolts of the business.
Yep.
And to look after the commercial development of the organisation.
And hold Roger back every so often. Don't buy that, Roger. It's okay. Don't do that.
And to keep Roger on the straight and narrow.
Right. And that would be fun. How many people work in the business now?
There's a dozen.
Yep. And it's going well?
We're very pleased with the progress.
What's the, I suppose, how would you characterise the business? Like, if you're a fund manager, I always think people say, okay, it's fun. Some people might focus on returns. What are your metrics that makes it interesting for you as a CEO that you say, look, this is why I'm happy?
For me, it's about the returns to our clients.
Yep.
If we deliver a great return to our clients on a sort of a fairly low risk basis, our business will grow.
Yeah.
We're very good communicators. Well, as you know, particularly with Roger as a front man. I've got some superb deputies and lieutenants in the organisation, so I just focus on really delivering great returns for our clientele.
So what sort of trends are you seeing from the client set? So in other words, you're delivering great returns, and are they saying this is a great return, particularly compared to somebody else? Like, in other words, how's that fund management world working?
I'll give you an example. We've had this retail product called the Montgomery Fund that launched in August 2012. So it's about 32 months old. In that 32-month period, it's put on about 70 percentage points after expenses, and
Yep.
the market has put on about 50 percentage points. Now, that's an interesting story in itself, but what makes it more interesting is that through that 32 months, the fund has probably averaged over 20% in cash and 80% invested, so that's the first point. The second point is it's been very underweight the leading 50 stocks and very overweight the next 250 stocks in the market. And so what we've done is we've been able to manage to add a lot of value in the sort of, you know, stock number 80 or stock number 120 or stock number 200. And we've, just for the viewers that don't know this, the leading 50 stocks tend to represent about 80% of the market by market capitalisation. So most Australians are really top heavy. You know, they've got the four banks, they've got Telstra, they've got BHP, they've got Rio, they've got Wesfarmers, they've got Woolworths. And the issue
They've done well by it.
They've done brilliantly by it. But the issue is it's a very, very thin market. We're talking earlier this evening and saying that financials, for example, in Australia represent about 35% of the market.
Yep.
In most other Western world economies, they tend to represent 10 to 15% of their market.
So I was thinking about that. So tell me how that would be, say, on the DAX or the CAC, or so
Yeah.
like for like. If you compare us with the US, 300 million people, you can't. But if you compare us with Canada,
Yeah.
you know, how does that then play? What's the Canadian centralisation?
Most other Western world economies, the financials within their listed index is about, say, typically 15%.
Yeah, right.
In Australia, it's typically 35%. And what that tells me, and then obviously Australia's very, very overweight materials as well. You know, we can talk about that a little bit later.
Sure.
But what it really tells me is that our listed economy, in terms of really brilliant industrial companies that might have global ramifications, is very thin.
Yeah. I suppose to some extent, I think about that 35% in the banking sector. APRA would say that that's an endorsement of how it's a de-risked business, because when you think of globally, banks have been really under the pump. I mean, imagine, I've got no idea, but imagine what the UK bank index would look like. It'd be tiny, I would have thought, because it's the government owns it, or, you know, people can't get out of it. So maybe there's something to do with that. But your point's really well made. I mean, I talk to UniSuper and they say, as we grow, we need to get overseas capacity to invest, because, you know, where will you get? If Chris Joy's right, which he's not always right, but if he is here, in his intergenerational assumptions, you know, 10 million people in Sydney and 11 in Melbourne, you'll need to have another place to put that bucket of money.
Yeah, I think the biggest issue is the superannuation guarantee pool is forecast to go from 2 trillion to 7 trillion over the next 20 years.
Yep.
And the economy is 2 trillion and the listed market is roughly 2 trillion. They just won't grow as quickly as the superannuation pool. So the superannuation pool, instead of being a ratio of 1 to 1 to the economy or to the listed market, it'll end up being 2 to 1 or 3 to 1. And so proportionally more money needs to go offshore.
Where do you, something like Alibaba is an it's a New York Stock Exchange listed company. It's A+ or A-, it's around about there. And it trades at 70 bits higher than, say, Singtel. So it's kind of, there is a China premium that the investor base haven't yet got their head around. They demand more from the Chinese issuers. That's just the way it is.
Maybe a fair premium still.
Yeah, no, it might be a fair premium. In terms of the equity market, where's the chase for yield story going to play out? Let's say over the next year, I mean, I don't know what your thoughts are on the cash rates, but a lot of people think they'll be going again. There'll be another move, even though we had a good employment number. Yeah. What happens in the chase field now on that?
Well, it's a classic squeeze. You know, we've got my parents' generation who are, you know, getting sick of earning 2 odd % in the bank.
Unbelievable.
And, obviously, if there's another cut, you know, it'll be a little lower. Yet markets, you know, we think are probably a little too expensive in general terms. There's pockets that are okay value, but what we think in total terms, you know, it's a little too expensive. So we're probably 25 to 30% in cash, waiting for individual opportunities.
How does, I mean, obviously your performance has been really good. Do you ever have any pressure from the investor base saying, let's spend the cash? Do you ever have an engagement from them saying, look, we are going to wait, so therefore my returns might be less if the market rallies further, goes for 6,000?
All our education, Mark, is based on telling our clients that if we find the opportunity set very thin, we'll let the cash build. And some people ring up and say, I don't want to pay the fees because you've got so much cash, and we go, then obviously you're not the right client for us and we're not the right fund manager for you. And it's pretty simple, because our view is that we're doing this bottom-up research every day. If we can't find opportunities, let the cash build and be very disciplined about it, because markets are very fickle. You don't need sort of something out there that you can't see every day of the week, and the markets can fall 10%, 15% really quickly, and then suddenly there's some superb opportunities available.
Are you worried about the liquidity of markets at the moment? Are you worried that you know, we've got some stories we'll talk about later on the show about how the Fed can lift rates, but are you worried about the fact that everyone is so long?
No, my biggest worry, to be completely candid with you, is there's some deflationary aspects that are starting to rear their ugly head in China. And I think that that's starting to sort of infiltrate the Australian environment through really, really, you know, scary prices relative to where we were 3 or 4 or 5 years ago. And I think Australians are only just starting to get their mind around the ramifications of that.
We'll try and get the Australians around their mind after the break. We have to go to a very... So walk me through it. What are the deflationary pressures you think are being transported from China to Australia that you think stand out? Okay,
so the first point is that you've got this GDP deflator number that came out on Wednesday in China, and over the last 3 or 4 years it's been running at typically positive 2 to sort of 7 percentage points has been the range. And suddenly, for the first time since the GFC in 2009, it's come in negative, and it's come in at negative at about 1.2%. Yep. So when they state their GDP as, say, 7 percentage points, their nominal GDP, in fact, is 5.8%. Now, that 5.8%, the nominal number, again, is the worst number we've seen since the global financial crisis. But then if you sort of filter through to work out why is their GDP deflator negative, you look at, say, their property sector, and their property sector is going through pretty serious structural problems. So, for example, cement output in the month of March was down 20% year on year. Well, why is cement output down 20% year on year? Because obviously the build coming through is a bit quieter than it was X months ago or X quarters ago. So then on the other side of the coin, you've got industrial production growth, which is running at a 5.4% year on year in March, and that's the lowest it's been since the GFC again. So it's no wonder that China generally wants less of our commodities at the same time that we and the world tends to be producing more of that commodity in question. So when we sort of look at underlying prices, it's no great surprise they're half or a third or a quarter of what they were 3 or 4 years ago.
I worry for the people out here who mainly buy term deposits. 3%, under 3%, whatever they are. They don't trust fund managers. They don't know about the bond market, so they don't go there. They probably buy houses because that's what they know, and term deposits. Where's the low-hanging fruit?
Well, for us, it's just been incredibly disciplined finding very high-quality businesses with good prospects at the right price relative to our assessment of intrinsic value. And what we've found in the last 12 months, there's probably been 3 or 4 really superb opportunities of some IPOs.
Oh, yeah?
Where the stocks have gone up not a million miles away from 100 percentage points from their float price.
Can you give me some examples?
Yeah, so a business called Isenti, or ISD is the ASX code. It came on in June last year at $2.04. It's now about $3.60.
Is that the one where they do? Is that the credit business?
No, this is a business that is a corporate monitor type business, and they've been very, very successful. Another business, which is a patent business, International Patent Holdings. That they've effectively doubled since their float in the most recent sort of 6 or 8 months. So there's some low-hanging fruit, but you've got to know the brokers that are floating it,
and trust them,
or have some sort of link to the companies. But there's 3 or 4 of these. Even Medibank, you know, it was $2 and it got to $2.50, so quick 25% there for some investors. So if you're fast on your feet, you're quite high quality, good prospects, and buy them at the right price, you can add a bit of value.
I'm going to talk about being fast on your feet after the interest rates here. I just want to pick up on something you mentioned about essentially the way I think of it is the granularity needed necessary. It's now necessary. Because you were saying, okay, you could buy Medibank at $2, get 50 cents, sell it. Days gone by, people would have said, just never sell it, just buy it and hold it forever. I'm of the view that the people watching this show need to have a little bit more alpha in their performance. They need to be able to take that 50 cents, put it in, go back to cash, see the next opportunity and go again, and be a little bit more granular, because cash rate's been so low, or the returns you're getting. And this is absolutely true in the credit market. In the bond market, when you see the profit and you look at the relative value, so let's say I buy IAG bonds versus an AXA bond, like for like, I might sell one to buy the other and vice versa as they move out. Or, you know, the ones that a lot of people would do, Sydney Airport 20s versus Sydney Airport 30s, and they'll just trade it. Is that something that you would advocate for clients around the idea of, or the broader estimates that they need to take more control, be a bit more granular? Well,
if they've got the time, skill and inclination to do the analysis. So Medibank Private versus, say, ICT or ISD and International Patent Holdings, IPH, is 3 cases in point. In one, we have a valuation of, say, 260. So when it gets near 260, we're out. Yep. In the other 2, we kept increasing our intrinsic value estimates, because every time they reported, the report that they came out with was so much better than we'd anticipated. So we kept pushing up our estimates. Now, if someone at home has the ability to then say, oh, my intrinsic value on this stock went from $3 to $3.50, I'll stick it out. Oh, my intrinsic value has gone from $3.50 to $3.80, I'll stick it out. If they have that ability, then it's much better to own a superb business with those prospects that just keep improving over the long haul, and just putting it in the bottom drawer. That's the perfect stock. Yeah. So I've named 2 of the 3 of them. In the third case, Medibank Private, I don't think we're sort of going to see that necessarily. So you've got to be a little bit more aggressive in your buy-sell type dynamic.
The way I look at it, though, I'm taking it back to bare bones. I think of it as I'm about to roll a TD at 70 over, and there's something that is 150 over, or that I just showed you an ANZ hybrid at 260 over. So I go, okay, hang on a second. Do I roll the TD, or do I go to a broker and buy ANZ 1-year hybrid? Well, I might do that. It's you know, 260 versus 70 basis points. I think, and how much time will that require? I think that's probably, you know, an hour a month, an hour a week.
Okay, and the equities market's different. So there's this academic from Wharton called Jeremy Siegel, and what Jeremy Siegel says is that the equities market, on average, over the very long haul, will give you CPI plus 6.5 or 7%. So in Australia, over the very, very long term, CPI has been about 3.5 percentage points. You know, I'm talking over 100 years. It's averaged about 3.5, maybe 4 percentage points. So the market has delivered between 10 and 11% over about 100 years on average, inclusive of dividend return. Okay. So what happens is that within that, there's many stocks, because of survivorship bias, that have done better and many that have done worse. And so the idea, obviously, is if you can find 5 or 10 that can do so much better than the average and just put them in the bottom drawer for a decade or 2 decades, then you're going to do so much better than the overall market. It's not even going to be funny.
Right. I do think, and then I think, beating the market is one thing, getting the return to live off is a separate thing. So I didn't beat the market. The market did 12 and I did 9. I'm still happy at 9. I mean, I'm not 100% certain. I'm yet convinced that beating the market is the answer. Meeting your liabilities and your returns is what's driving me first, if you know what I mean. For the retirees, That's the, I'm thinking more about the people that be watching this show as a retiree.
But I think you're not really picking up between capital gain and dividend.
Yeah, true.
Because the thing about capital gain is you can always, if you've bought something at 100 and over a long period of time it's gone to 200, but hasn't given you the yield that you were hoping for, you can always sell a few at 200.
Yeah, true. No. Which one? I mean, inflation's going to hurt everyone. I sort of think that if you're going to buy inflation, just buy corporate inflation, corporate bonds, so that are linked to inflation, or an infrastructure, you know, Transurban. That's sort of some entity that can change the price that reflects the inflation embedded. So if you've got like a hospital goes up, or a parking lot, or that sort of stuff. But I would think corporate bonds that are linked to inflation, so corporate link as they're called, would be something you'd look at.
Really illiquid though. Hugely illiquid.
But that's why you only have a small portion. It's just like a savings bond. What do you think about inflation? Do you ever?
Well, there have been plenty of academic studies that say that equities can do quite well as long as inflation doesn't get out of hand. If it just runs along at 3 or 4 or 5%, it's acceptable. And traditionally, you run to stocks that have pricing power. And there's many, you know.
You've got to have a good moat. That's right.
There's plenty of brilliant stocks globally that have very, very good pricing power.
Like a Google and Microsoft.
Colgate, Palmolive, you know, et cetera. There's dozens of really great brand names.
That's what you need to look at as well. That pricing power, if you're comfortable with the equity market, otherwise you buy corporate inflation, or, you know, there probably is some other options around, but it's only a new world order at the moment. We don't have much in the way of inflation products like annuities. What about your guys? What about the types of investors that you would have? Are they early adopters to that we're just going for growth, we just want growth? Or when you engage those clients in the education story, do they give you all their money in general? Like, I don't want specifics, but you know what I mean? That here's all my cash, look after it, see you later, David? Or do they say, I want growth, here's half, I'll put half in a term deposit?
No, I think every individual has a different level of tolerance to risk.
Yeah.
And I think the GFC, where the share markets globally halved in no time at all, anchored a lot of people, and I think a lot of people have got too much money in the bank earning next to nothing on it, and they're feeling squeezed now because equity markets all around the world, particularly the parts of the Western world, are making all-time highs, and they're earning a massive 2.5% in the bank and going, gee, I've missed a rally of, you know,
2013.
You know, in Australia 50% the last 3 years, and obviously in continental Europe, UK and America, you know, are factors of that. So that's what a GFC does. It makes you get bearish at the most inopportune times because you've probably been bullish at the most inopportune times. But the biggest issue we have is that people who retire at 60 are going to live generally till about 85, and you can't get too conservative if you've still got 25 years to live.
Yeah.
You might get conservative when you've got 5 years to live, but not 25 years. And so I think you've got to take a really medium-term view and just keep doing what you're doing, and in our case, high quality, good prospects, right price.
Do you think the GFCs continue to affect everyone? I mean, I feel the GFC's it still affects everyone as much as it did as if we were in the middle of it. I think
it's very like the deflation. People have a memory, like the depression.
Yep.
People have a memory and they just cannot leave that memory. And the memory is, I had $100 in equities and I turned it into 50 in 6 or 9 months, and I'm petrified I'll ever do that again. And so I ended up putting a lot of money in the bank, at the most inopportune times, and I've just seen global markets in many economies hit all-time highs, and gee, I'm now feeling squeezed.
And also, I think the other thing about that is, A, they had a bad experience, but they also had a bad experience with their advisor, and it never occurred to them that the advice they were getting just wasn't appropriate. To your point earlier, you said everyone's got different risk tolerance. I just don't know that they know what it is. Like, if you say to me, what's your risk tolerance? I might have a better idea, but if you ask most people, they say, well, I'll take moderate risk, and they don't really know what that means.
Yeah, well, I think it's, I never want to lose, turn $100 of equities into $50 again.
So you just don't want to take any risk.
And so people, by definition, are being a lot more conservative than they probably should be.
Yeah. Look, that's all we have time for today, so thank you very much for the guests that I've had, Sue Wang from Mercer and David Buckland from the Montgomery Fund.